Hey everyone, Spiero here, Buy and Hold Fundamentals. It's Saturday summary, got my trusty coffee, and let me take a slip. We're now at the end of looking at Milwaukee for a week. So I've done some summarizing, and let's have a look at what we can try and start to eke out as we look at what the data tells us. So what we've done over the last week is looked at 100 houses under 150,000 in Milwaukee, in some of the neighborhoods there, and now let's look at what the averages tell us. So on average, looking at this list first, on average, the price is falling around $75,000. The rent's at about $900. Cash flow is just squeaking past zero. Cash on cash is at 3% on average, and the rent ratio is showing up as 145. Now, if you've been watching this week, you'll have noticed that I had a theory about the rent ratio needing to be somewhere between 1.3 and 1.4 before it started making sense. That bore out when we look at the individual units. What you're seeing here with this sort of average, you're still not really getting there. But part of that is the fact that there's a bunch... I think there's two things going on here. There's a bunch of properties that really, really don't cash flow. And then there's a bunch of properties with really, really high rent ratios. Mostly because you're looking at the sale of really rundown places. So that's sort of skewing the averages. I think that the average here on the rent ratio is a little high. I'd say that if you were to neutralize those weird places, that would be a little bit lower, and you'd see a continuation of what we saw during the week. You might also remember that there were a number of properties where there was data missing, either on the rent or the taxes or both. So I just made some assumptions on the numbers, but those properties really aren't a reflection of at least what the way that Zillow's presenting the market, because they're not finding data there. So if I exclude those properties and just look at the ones where we did have full price, rent, and tax data, what we're seeing is that there's very little impact from those estranged properties. Basically, the numbers are staying the same. So we're still at 74. Rent's down a tiny bit. Cash flow is a little bit up because we got rid of all those weird properties, and cash on cash and rent ratio are up as well. But no real change. When we look at distinguishing all the properties that when we start looking at the subset of the properties that are actually worth a look, and let's see how many there are because I filtered them out. So there we go. So having looked at 100 properties, there's 15 out of the 100 that are worth a second look, which I think is probably pretty good. And the average for that is, as far as the price concerned, much lower than the group average. So it's 43,000 as an average price. The rent is a little bit higher, but I mean effectively not much different. The cash flow is obviously very, very different, as is the cash on cash. And I think that part of what is a good indicator to that happening is the fact that the rent ratio here is much, much higher. It's almost an entire percentage point higher than the averages. So I think that's sort of what's leading into there. What we would need to do next way to look at these properties is try and figure out a couple of things. One is make sure that we validate that the rent rates that we picked off of Zillow make sense. Secondly, what I would do is try and figure out which of these need some kind of rehab and make assumptions about how much that is, and be very conservative there. Meaning, if you think it's just a little bit here and there, just some paint and some carpet, which would cost $5,000, assume it's going to cost you $10,000. If you're going to have to replace a bathroom and a kitchen, assume it's going to cost you $25,000. That kind of stuff, so that you get a fair indication as to what, rather than a fair indication, you get a conservative indication as to what still works. Now, what that's going to do is, for the majority of these properties, if they need rehabs, they're going to stop becoming interesting, right? If what I'm looking for is a cash-on-cash return of 10%, if I suddenly add another $25,000 in costs, which, by the way, I got to put in initially because I'm not going to get a loan on that until I can refi the place. Suddenly, if that changes the number so drastically that it doesn't make any more sense, it might turn out that there's nothing in this list of 15 that I still want to look at, or maybe there's just one or two. But again, from having spent, it's 30 minutes, 5 times 30 minutes is 2.5 hours, spending another 2.5 hours researching these places, so 5 hours to get a real potential buy and hold investment property is pretty damn good, if you ask me. I mean, if you can spend 5 hours a week, then you're finding one of these a week, which means you're finding 4 a month. And let's say you want to buy 4 a year. You're probably going to find your 4 apartments, even just looking at the MLS. And just by looking into this town or any other town, you're going to become more familiar. The fact that you're going to talk to real estate agents and ask them questions which will indicate to them that you actually know what you're talking about is going to lead them to showing you other things that they have that are not necessarily on the MLS. And because you already have an understanding of what the average prices are like, what the rents are like, what's normal and abnormal as far as tax is concerned, when they show you something that actually works, you'll be able to pounce on it. Anyway, so that was the Saturday summary for Milwaukee. I'll be back tomorrow with a multifamily Sunday. Some interesting things happened to me on the way to some Facebook forums, and there's a neat little trick that I figured out going into one of those.